For you to quit your fucking job, all you have to do is find something that repeats every day that can yield you 5 handles. Here's the easiest, most straightforward ICT lecture. Ready? Watch price in the morning between 9:30 and 11 o'clock. Wait for price to run through a liquidity above or below. You don't care about a bias. I don't need a bias. I teach you because it's better for you to work within a higher time frame directional bias. But if the brass tacks was laid down, here it is. This is it. All I would be looking for is I want to see an obvious run above a high or relative equal highs and then reject that. I want to see an opposing liquidity pool. I want to see it move sharply in that direction. Once it does that, any fucking fair value gap, any of them, once that occurs, as soon as it trades into fair value gap, I'm using that. I'm putting a 5 handle stop loss on it, and I'm waiting for it to rip. 5 handles, half my trade's coming off, and then I'm waiting for it to trade in the opposing liquidity. There it is. And in 90 days, I'm quitting my fucking job. I don't look for price patterns. I look for inefficiencies and liquidity. That's it. That's all there is. And I look for that in time. So let's look at the London session. Now, as far as indices, I haven't talked too much about indices, but we'll be doing that. And I actually got some live sessions we'll do during the London hours. What's that? I got to call out of work. I can't miss that ICT. There you go. Anticipation. You can't react to it. So London, by characteristic, what I'm referring to is, we always refer to things in New York local time. So whatever the time is in New York, you need to have a clock set at your trading desk. So when I talk about specific times of the day, it's always on the basis of New York. Okay, so London time, between 2 o'clock in the morning, New York local time, to 5 a.m., New York local time. That's a 3-hour window, and the sweet spot is between 2 o'clock and 4 o'clock. So those 2 hours, but it can extend to 5 a.m. Generally, you're going to get some kind of false breakout. Okay, and that's not earth-shattering. There's always been some idea of expectation of anticipating some false breakout in London. That's just the natural characteristic to it. What you need to be concerned about is where we are coming from on the hard time frame weekly and daily chart. If you're trading in London, if you're not referring to the weekly and daily for your setup, you're trading blind. You have to look at what that weekly, what's the importance of the weekly chart, Michael? Well, I talk about how you can anticipate, not react, anticipate where that weekly chart candle that's forming, or that will form tomorrow when it starts on Sunday at 6 p.m. when all trading begins. Now we're starting a new weekly candle. So you want to anticipate the likelihood of that weekly candle expanding up or expanding down. And you're looking for an inefficiency or stops that's most likely going to be the draw. You have to factor in what that weekly chart is doing, likely to do, and that starts your bias, bullish or bearish. And on the daily chart, you have to confer with the previous day's range. Now let's assume for a moment that the weekly chart, you're going to look at the previous day's range, and let's assume that you're looking for lower prices. You think that that weekly candle is going to expand lower, and you want to look at yesterday's daily range. And it does not matter if yesterday's daily range is up close or down close. There's more advantage if the candlestick from yesterday is up close, because you want to see a move that breaks below that yesterday's low. Once it does that, that lower 1/4% or lower third of that daily range, if you are in fact correct about your analysis and it's going to go lower, based on the weekly chart, your sell setup's going to form in the lower quarter or lower third of the previous day's range. Now, by itself, that's not earth-shattering, but I'm going to tell you something right now. If you chase price action and you always get burned, go back and look at your losing trades and you'll see that's exactly what you didn't see. So it has to refer back to a previous portion of the previous day's range. And this is not new. This is all in my core content. I teach this in core content. But so in London, you're looking for false breakouts. Okay. And you want to see, now this is where you write stuff down, folks. You want to see some measure of a 15-minute or 5-minute relative equal highs inside of the range that would be in the lower third or 1/4 of the previous day's range when you're bearish. Okay, we're anticipating that future reaction by price. We aren't reacting to price. We're anticipating price to do these specific things, which is what? If we're bearish in London, you want to look for a single high or a relatively equal, like equal highs inside of the previous day's lower 1/3 or 1/4 part of the daily range of yesterday. Whatever the pretty simple rules, right, folks? So in between 2 o'clock and 4 o'clock, we would anticipate a rally above those relative equal highs on a 5 or 15-minute chart, whichever one's easier for you to see. Regardless, you'll see it. If you want to use a 15-minute chart as a bellwether, I use that as mine. But you can look at it on a 5-minute basis. And as it rallies above that, what's going to be resting above those relative equal highs or single high? Buy stops. And the characteristic for the London session is to run up and entice traders to chase it going long. When in fact, it's a function of running into buy-side liquidity for smart money to absorb those buy stops and be counterparty as they flood the market with buy orders. Shorts are entered by smart money there because it's a run on liquidity. It's engineered to provide a entry mechanism for smart money to go short. It takes a lot of confidence to take that type of trade because usually in London, the Judas swings are very violent and they're quick. And it feels like it's going to go up 100 pips. It's going to go up, 80 handles on the S&P. Look at this thing move, man. Wow, it's gone up 12 handles. Look how fast it's moved. This thing's going to keep on going. If you feel that way, you're reacting to price. When we're looking for that to be a run real quick to get to those stops so that stops can't be pulled. And once that happens and the orders are not pulled by the traders that have those orders resting there, we anticipate price rejecting there and going lower. Now, if you can't take that type of trade or entry in the beginning, you won't. Let's just be fair. I say this all the time. Buying sell stops and selling short buy stops is one of the hardest things to do as a trader because at the time when it happens, it's fast, it's furious, and it's scary. And you have to know what you're looking for, which is why you have to anticipate and predict the future. You have to. So in London, you're looking for false breakouts and runs above relative equal highs when you're bearish or a single high that is inside of the previous day's range. Let's just say, hypothetically, you draw a rectangle, leaving room for a rectangle to the right of it, okay? So you're going to draw a rectangle, and at the top of that rectangle, you're going to say 100 is the high, and the low is 20. So you have a previous range of 80 units. It could be pips, it could be points, it could be whatever. But we're going to say it's 80 units. Then you're going to see where you open up at 2 o'clock in the morning, New York local time. 2 o'clock's opening price. What is that? The first opening price on the first 1 minute candlestick at 2 o'clock, New York local time. You want to note that. Now that's an important price point. From that price point, you want to see it be, if you're bearish, you want to see it be below the 20 level of the previous day's range, because that's what that rectangle would represent. And that's, for example, let's just say at 2 o'clock on the trading day that you're in right now, say it's 18 in reference to the previous day's range. So now you're below the low of yesterday's daily range. So from 6 o'clock all the way now to 2 o'clock in the morning, the market has done whatever it's done. If those highs, that relatively equal high or a single high in the previous range between 20 and 80, if there's a single high or relative equal highs in that lower 1/3 or quarter point of that previous rectangle that you're drawing out, that represents the previous day's trading, you're anticipating at 2 o'clock in the morning on the trading day that you're watching price at right now, you want to see a Judas swing shoot up. You're going to anticipate that. You're not going to react to it. You're waiting for it. You want to see that very thing happen. Now, as an ultra short-term scalper, you can buy that, but you have to be very nimble because it can go up there and turn on a dime quickly, because London is a false breakout characteristic time period. When it runs up there, why are we anticipating a run back into the previous day's range, but only the lower quarter or 1/3% of the range? Because we don't think that the previous day's high is going to be taken out. And we don't think that half of the previous day's range is going to be a factor at all. The best shorts are going to occur in the lower half of the previous day's range when bearish. What did you just say? The best shorts will occur in the lower 50% of the previous day's range. Where do they form? Above old highs, inside of that range. Where you look for it, just like the algorithm will look for it, it's going to look into 15-minute high or highs, or 5-minute high or highs inside that range. So if you're in a 5 or 15-minute chart, it can't hide from you. It's right there. And you're going to anticipate the market running up there. And when it does, you paper trade it. You tape read it. You do not live trade it. You have to condition yourself to do this. And it takes weeks and months to do it. Not, oh, a couple weeks I've been doing it, I know what I'm doing. No, you don't. No, you don't. You do not. It takes time to desensitize yourself to the fear that London can create, because it's very, very volatile. It can run up there and rip right lower, and really, if you know what you're doing, you can miss it or second guess it and totally do harm to yourself. So in London, you're looking for turtle soup scenarios, okay? And continuation on the basis of the higher time frame order flow. High a day, low a day is what's formed in the London session. Most of the time, not all the time, most of the time. In New York session, this is going to be for Forex traders, the New York Open Kill Zone, which is 7 o'clock to 10 o'clock, New York local time. If you are an index trader, you can use that same time window as well. You use that time window before the opening at 9:30, like between, like, say, 7 o'clock in the morning, New York local time, to 8:30. You can trade that time window when there is a really big high impact news driver for that day. For instance, like FOMC. Okay, say FOMC, or let's say, well, we'll stick to that. FOMC is probably like the best case explanation for why you would want to trade before the 8:30 hour. Because generally what will happen is you'll get these really nice little price runs that are, and I've executed and showed you this throughout the year, and last year I was doing it too. And usually it's the time or examples where you see people saying, but didn't you say we have to wait for this and we have to wait for 10 o'clock? Folks, I'm giving you different models. That way you are allowing yourself to pick up on what you want to do. I can trade all of them, but I can't make you be able to trade all of them. I mean, over time you can if you put the time into it, but you have to find your own special time of the day in the asset class that you trade. And that's what I'm covering here. I'm helping you refine your level of focus so you can pinpoint what your model is going to operate in terms of time. So that way you're not doing more than that's required. You're not diluting your attention, and you're also controlling fear of missing out. Because if you're operating in a business model or trading model that allows you to only operate in this 2 or 3 window time period of every individual day, you turn the charts off and you walk away and you exercise discipline. I'm looking for setups in the New York session. The characteristic for New York is a continuation of what? Whatever London did. When does that not occur? If the range expansion that occurred in London and then continues into New York and it trades to a higher time frame PD array, something that I would have been targeting anyway, which was the basis for the draw on the bias for the weekly chart and or daily chart. So in other words, if it gets in my higher time frame target, then what shifts in my analysis? Market reversal profile. Otherwise, I'm looking for New York session to continue in the direction of whatever that higher time frame draw is on the weekly and or daily chart. And I'm going to submit to that. And I'm going to look for the things that I teach you that the algorithm will show in price delivery, inefficiencies, runs on stops, the whole business. I'm looking for those factors to come in agreement with that. And if it doesn't materialize, or if it's wishy-washy, it could be done and explained both directions. That's low probability. It's not a trading environment I'm going to trade in. And then I watch, or I'll tell you, this is what we're looking at. We're watching it. So it gives you experience to see what it's like when it's not optimal, but still putting chart time in. So in New York session, whether you're a Forex trader trading between 7 o'clock and 10 o'clock in the morning New York local time, or if you're an index trader trading anywhere between as early as 7 o'clock in the morning all the way up to 11 o'clock, you don't want to take any new setups after 11. Unless, now here's the caveat now, unless your model is to trade in the lunch hour, which takes much more experience. In the beginning, I don't want you to try to do that because you probably don't know very well where liquidity would be resting, how it would work against the range that's already formed for that particular day. You wouldn't know what liquidity pool to aim for. But the New York session is a continuation of whatever London is. So if London was going down and it has not reached your higher time frame daily or weekly objective, we expect some measure of short-term retracement and then continuation in the New York session until the higher time frame weekly or daily objective that we would be reaching for as a draw on liquidity, the target. When that's hit in the New York session, then you are entering New York reversal profile, not market profile where they have the vertical volume bars going horizontally across the chart. That to me, I don't use that stuff. When I say profile, that's like a schematic or a roadmap or a visual representation of how the market should perform if you were looking at it from like a line chart basis, how it should look after the fact. But we're anticipating it to perform or behave a specific way. So New York session's continuation of London, and then New York goes into market reversal profile, where whatever happened in London in the early stages of New York now reverse, and the market goes a different direction. Whether if it's going lower, now it will go higher, or if it's going higher, it will now go lower. If and when it hits the weekly or daily objective that we were aiming for, that framed our bias or premise behind our trading week. Silver bullet inside of the AM session. That time window is very, very specific. It's inside of 60 minutes. Now, that doesn't mean the entire trade is encapsulated inside that 60 minutes, but most of the time you're going to find it is. But you can find the entry in between 10 o'clock and 11, and all you're looking for is a continuation of what London and or New York is outlining. So we have a target. We're looking for a draw on liquidity. It could be a new week opening gap that we're aiming for. It could be a fair value gap above the marketplace that we're aiming for if we're bullish. And that draw on liquidity is what we're looking for, a reach from that fair value gap that forms, whatever the fair value gap, the first one that forms between 10 o'clock and 11, that one, you're going to see that right there, that's going to be a catalyst for a minimum 5-handle run. The lunch hour, the New York lunch hour, is technically 11 o'clock in the morning to 1 o'clock in the afternoon, New York local time. So it's a 2-hour window. But lunch hour trading is a real thing. And the algorithm operates on that mechanism of reversing back to whatever the session in the morning stops, wherever they're at, whether they're bull stops or not bull stops, buy stops or bear stops, sell stops or buy stops rather, buy side or sell side. And as an example, let's assume that we've watched the market go higher in London, and then we had a continuation in New York. And whatever the target is that we had for our weekly chart or our daily chart has yet to be reached. So we're still below it. Your expectation for the lunch hour between 11 o'clock and 1 is you want to go through and look for where a relative equal low or a 15-minute low is, because that's exactly where the algorithm is going to go. Don't take my word for what I just said. Don't just say, because ICT said it, I believe it. No, go back and look through your charts and you will see what I just said is algorithmically proven to you. It goes on every single week. It happens this way all the time. It does it all the time. It's flawless. It never fails. It's always in the charts. You can set your life around it as a model. This is one way that you can look outside of the AM session and the PM session and go right in there. Once you understand how liquidity works and what you're looking for, that could be your model, your setup. And I have done examples of that last year and this year, recording my entries. And you're buying those sell stops. As it runs underneath it, you're buying it. What makes it better? If there's a fair value gap or a volume imbalance just underneath that low, that right there is a unicorn. Why is it going to go down there? Because it's going to pick up more orders to allow smart money. It's not selling pressure. It's not a lack of buyers that I'm talking about. The mechanism that is the market that was coded and brought to us as a price engine that causes the fluctuations in price. And then you chase it. Other traders, they chase it. They go in there, buy and sell after it. It will use that human psychology to know that there will be trades printed at the levels they want. When the algorithm's running, it's not going to go to some random level. It always goes to something that I've taught you as a PD array. It's always like that. That, it takes more faith to believe in that than simply there's an algorithm that controls how far price will go. You have a belief and understanding that there's a circuit breaker, right? The market goes down this much, they halt trading, and it has to be, a number of time. Interesting, isn't it? Time has to transpire, and the market needs to uptick before they'll let lower prices start. Well, and I told you before it was going to happen. In lunch hour, that 15-minute low, when it's been bullish and we haven't hit that weekly or daily objective, it's going to roll down there. It's going to go right below that low. And it's going to engage those sell stops. And the market's going to be flooded with willing sellers at a low price. Why, pray tell, would that be advantageous? Because smart money will be buying those sell stops to reaccumulate new longs, add to or start new positions, and wait for that higher time frame weekly or daily chart objective to be met. And then you'll watch the PM session roll through and reach higher to that target or get closer to it ever so slightly. That's that liquidity matrix. Understanding where you are in it. You have to know where the market's going to go. That's the first rule of Fight Club here. You have to know, where is it going? You have to know that. If you don't know that, everything else afterwards, you're lost. If you don't know where you are going, where the market's being led to, it's an obvious level. It's in your chart. And that's what I'm sharing my experience with. I'm pointing to those things. I'm hoping that you're aligning yourself with, okay, I'm going to submit this studying price delivery in the basis of it's going there. And filter out all the things that would be opposing that as an idea in terms of trades. Accepting the fact that there will be fluctuations that you didn't participate in. That's okay. That's discipline. That's you sticking with a rule-based idea, and you're keeping your focus on what is the highest probable direction. The market goes up and down, folks, up and down, up and down. But where it's going to ultimately, once it gets there, then you can look back and say, wow, yeah, I can see how it was obvious there. But I'm teaching you how to see the obvious real time. It's not easy for some of you. Others, it is. But most of you are going to find that it's very hard to do that because you want it to be easy. And I want to be able to make it easy for you. There is no other way to make it easier. You have to go through it. You have to condition yourself. You have to look for it to repeat over and over again within specific times of the day. So between 11 o'clock and 1 o'clock in New York local time, you're looking for a run on stops. What stops? The stops that have not been hit, and punishing those individuals that may have trailed their stop loss up below an old low or down below an old high. If you're bullish and it's been going up, a 15-minute low, underneath that, that's sell stops. It's going to run down there, take those, and then you're going to see it trade higher. Even if it fails and just goes to a higher high and never continues after that, that's still tradable. But some of you would think that that's a failure. It didn't keep going up to my target on a higher time frame chart, ICT, so that's a failure. Wrong. Could you get 5 handles out of it? And did you take 5 handles? That's how you start. That's how you build yourself up. That's how you grow. And eventually you do that enough and you start seeing setups that you know you've been here before. Yeah, I can get my 5, but let me take 5 off with half the position and leave a runner. And then you graduate to becoming a 10-handle trader. So silver bullets, you have a fair value gap setup that's very specific in that 60-minute chart or 60-minute time window. 1 hour. At 10 o'clock to 11 o'clock, you have the lunch hour that runs on stops. Whoever's been making money, that's what it's going to do. It's going to run down there. Even if it reverses in the lunch hour, that's still a trade also. If you can anticipate that drop down, say the market's been going up, London session, New York session, now you're entering at 11 o'clock to 1 o'clock an hour. You can sell short a 1-minute 2022 model and aim for that 15-minute low. What? Yes. Yes, Virginia. Yes, you can do that. That is a model in and of itself. And then you had the PM session, afternoon, between 2 o'clock and 3 o'clock. The same thing you would expect to happen in 10 o'clock to 11 o'clock, AM session, silver bullet. Well, look what we have here. Another 60-minute time window. We have to look for stops or inefficiency. Where's the market going? Where's it reaching for? You know you had that old high that you were aiming for all morning. It didn't get there. We have relative equal highs now across the afternoon. What's it going to reach for? The weekly and daily objective hasn't been met above the marketplace yet. So we're still bullish. Wait for a short-term shift in market structure, 1 minute and 5 minute. Wait for a fair value gap to form between 2 o'clock and 3 o'clock. And then when it drops down into it, when you're bullish, buy it and aim for that intraday high. If it can give you 5 handles, take it there. Leave a runner on and see if you can get to that higher time frame, weekly or daily chart. That's how you trade your afternoon silver bullet. Simple. Real simple. There's a whole lot more things you can add to it to supercharge it, though. But that's the easiest, simplest little approach to that model being there every single day. Even in choppy days, it's there. Oh, it's there. Every day. Then you have the last hour trading. 3 o'clock to 4 o'clock. I've taught you several macros that exist in that hour. And now we're talking about the extreme of the daily range for indices. You're not trying to trade Forex back then at this time. At 1 o'clock in the afternoon, that's it. You're done for Forex. Don't touch it after that. I don't care how much you see it do this and do that. You don't trade it. In London close, between 10 o'clock and 12, I apologize. I skipped over that in all my fever pitch about everything that's really outside the scope of this Twitter space that I had in mind. That 10 o'clock to 2 o'clock is the extreme range end of the daily range for your Forex trading pairs. It can extend to 1 o'clock, but generally between 10 and 12 New York local time. You can finish your whole business there and be done. But as an index trader, you're entering the lunch hour. Now you roll out of, say you're a Forex trader, and you want to trade the London session and New York session for Forex, and now you know that Forex goes a little bit colder the rest of the day in the U.S. hours. Stop trading Forex, roll over into indices, trade the lunch hour. Where's the 15-minute stop? Where's the stops? Who's made money? Where are they leaving their stop? Because it's resting right in the marketplace, and the algorithm will gladly go down to it or go up to it, and there it is. There's a setup there. Then we get that last hour. That's making the high or low of the day for index futures. Not all the time, most of the time. Unless it reaches the daily or weekly objective intraday, and that will be the high or low of the day. If it has done that, then the afternoon last hour trading has to be traded from a scalper's mindset, looking for a 15-minute high or 15-minute low or 15-minute inefficiency above or below the marketplace. And that's your target, and be content with it. Does it offer you 5 handles? If it does, get it and be done. So I've walked you through a daily range, mentioned the characteristics. They're very generic. Do you think about price like that? If you haven't been thinking about price like that, now you should. Because in my mind, the inner musings of the ICT, when I'm watching the daily range form, I have all these thought processes in my mind, and I'm anticipating certain things based on the logic I've showed you and talked about here. I am not surprised. I am not taken back in a gasp when the market does something at any one of these times of the day. I'm expecting all this stuff. But anticipating it and entering the trade is 2 different things. In the beginning, you need to just sit still and watch. And you desensitize yourself. You remove all the doubt, all the fear, all the trepidation about you being able to do this. Oh, it's rigged, it's fixed, it's fake. He only shows you the winning trades. He this and that and that thing. You have all these excuses that you have to sort out. All that's put to bed when you start seeing it happen over and over and over again. When you start seeing it live, pan out to script. Whose script? Mine. Not Elliott's, not Sam Siden's, not Wyckoff. Mine. This market is absolutely predictable. But there's times when the market's going to be a little fickle. This is simply going to give you the setups that you like to see. New York session, optimal trade entries. London session, turtle soups that shift into 2022 model or optimal trade entry. Breakers really do well in London. Reversal market profiles in New York session. All of these individual times of the day, the silver bullets are always continuation. They're continuations of whatever is in motion at the time. If you can't determine what is in motion, don't take the silver bullet. How about that? How's the logic for that? It's simple, isn't it? When in doubt, stay out.